Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. And on the show with us today is a new guest to the program, E.B. Tucker. He's written several large newsletters and has worked with some of the largest newsletters out there. He currently works with Doug Casey and some other very big names. E.B., welcome to the program. Thanks for joining us.
Thanks for having me, Colin.
E.B., as this is our first show together, I kind of want to start with a macro premise. You just had a very interesting event, and you go to a lot of events because of your job, and you're constantly doing research and trying to get a pulse on the market. Just went to a real estate event up in the Northeast, and I think you said that Pitbull was there and some other big celebrities, which is kind of a sign of the times. Let's start with what the event looked like.
Well, it was really interesting, and I was probably the only person there that was not interested in buying real estate, which was very telling. But so there's a conference circuit out there, and these things are always, like you say, a sign of the times. You can see what people are interested enough in to pay $1,000 to go hear people talk about. And the format here was they have Pitbull, who's a very inspirational guy, by the way, come out and talk for 20 minutes, and then they have a guy come out for 90 minutes and try to get people to sign up for a $1,500 system that shows them how to buy foreclosures. And that kind of goes on all day. And then your marquee event is Tony Robbins at the end of the day, who I actually got to spend a little bit of time with at the end. He's a really fascinating guy. But this is an indication of where we are. I mean, real estate is a cyclical business, and a lot of people own a house, and even more, people would like to own a rental house or kind of have some way to generate extra income in real estate. But as you probably know, the time to buy real estate was 6 or 7 years ago, and that's ironically the time when no one was buying it. And so if you look at real estate over the longer term, it runs in these big, broad cycles. And this is a time in the cycle where I'm not saying we're headed for an imminent crash, but it's just not that great of a time to buy real estate. These are depreciating assets, and if you make 3% on them, you're not going to end up 10 years later with the type of return that you were looking for. So Pitbull packed the house. I'd say there was 7,000 or 8,000 people there, and it was definitely a success for the conference promoter.
Yeah, and as you know, E.B., we put together a conference in Belize a couple months ago, dual focus being on mining and real estate. And our partner on the real estate side is a guy named David Zook, who's been focused on the multifamily market since the '08 crash, and it's done very well. But he would agree with you 100% that the opportunities are slim, and it's very cyclical in nature. So he's been focusing a little bit more on emerging markets at this point.
Yeah. I think that's how you got to look at it. Is you got to say I'm still open to doing a deal. If the corner of Main Street in your local town is a dilapidated diner, and you know that you can buy it and build something different and lease it out and kind of change the landscape of the look of the property, that's a deal you'd still do. If, like you're saying, if you could go to an area that you understand that's a bit different, that's growing. Like, for example, and I'm not advocating this for investors, but Brazil is a very interesting place to me because they have this kind of explosive population of young people. And so when you have like tons of people that are 20 to 25, all those people go to work. They all have to move out of their parents' house. They all need to drive a car somewhere. I mean, it's like you just have so many more people doing this. Well, if you could, hypothetically, in a market like that, you had someone that knows the market, like what you guys have done, and that says, listen, there's definitely opportunities here to make returns far in excess of what you can make in kind of hometown USA. That's something to be listening to, because that's an opportunity that really could work.
Yeah, we don't talk about real estate too much on Palisade Radio, but I'm very, very keen on really digging in and learning about it. You mentioned the cyclicality of the real estate market, but at the same time, for people investing in mining and junior mining, it's far less volatile, so you still have the cyclicality, but there's also like an insurance built in. If you own something real, the real estate can only go down so much, and it can only go up so much on the flip side. So maybe a future point for people really heavy in mining right now is to start looking out at real estate.
Well, it's a hard asset, so you check that box. And like anything, it has its downside. I mean, the downside that you and I probably realize is that if the local government gets in trouble, they have kind of unlimited taxing power over you because you can't move it. But But again, you're right. It's a hard asset. It runs in these cycles, and there's a fantastic time to buy. When in 2009 and 10, I bought quite a few rental properties in Florida, and I'm telling you, it sounds. I tell people this. I've given presentations at conferences on it, and people say you're a genius. No, I'm not a genius. I had a hunch, and let me tell you, when you're buying a house on a street and the whole rest of the street's boarded up, you do not feel like a genius. I mean, you come home and you tell your significant other, I might have made a big mistake today. and that's the thing about these market bottoms. The same is true in gold. I mean, gold and silver, you're uneasy when you buy a really, really great asset before the market recognizes that it's great. It gives you this kind of unsettled feeling where you second guess yourself. You say, man, am I right? I mean, look at this thing. And nobody knows about it. And that's oftentimes when you are actually making the right decision. Whereas when everyone agrees with you and you're the most popular guy at the cocktail party, you probably are a lot closer to a cliff than you realize.
So the housing market caused the crash in 2008, but it also brought down the U.S. equities and a lot of equity markets around the world. Since that time, you've had the general equities like the Dow and the S&P have climbed and continued to climb almost in tandem with real estate. So I just want to get your feeling on where we're at on the U.S. equity side of things.
Yeah, equities occupy most of my time. I mean, I'd say it's an area I've been focused on for almost 2 decades now, and it's tough because everyone says, well, the stock market's surely in a bubble because the Dow's 20,000. I don't think that's a safe assessment. The PE on the S&P is over 20, and that sounds expensive. Historically, it's expensive, but I think it's the kind of situation where you can't be 100% out of the market. And I just gave a talk recently where I told people, listen, if you're going to have 40% stock exposure, let's just say hypothetically, then have 20% of that in cash. So you've got some exposure to companies that you want to own for the long term, but you're also sitting in cash because the possibility of, let's just say, Donald Trump Donald Trump is a master negotiator, and everything he does, it's a big mistake to think that on the surface you understand it. It's entirely possible that what he's doing with this healthcare bill and with all these things is a ploy to end up in a government stalemate or a government shutdown. We're about to hit the debt ceiling. It's perceived that he lost on the healthcare bill. I'm not so sure that he lost. It could potentially be a setup to ensnare his enemy in a trap, right? So if you have a government shutdown, I think it's tremendously positive for gold and very difficult for the market. So you could easily see a 10% drop in the major averages. But at the same time, it doesn't mean that you want to be completely out of the market. You just want to have cash on hand to say, hey, if there's a company that I owned for the long term that I think is irreplaceable, it's not in danger from automation perspective. It doesn't suffer from declining margins and revenue. I really like this company, and I have a few of these we can talk about if you like. But you have some cash to add to that position. You're also not completely tied to the market. Keep in mind, there's tremendous margin debt right now. So it's a sign that people have stretched themselves a little bit. But I'd say we're much more likely to have a 10% correction, than a 40% correction.
And further to your point, I mean, how long have people been saying that margin debts were high and that this was unprecedented in length? And it's been 2 or 3 years now. A lot of people have been calling a bubble or a top, and it's continued to go up. So I think your call on this maybe not quite being the top is a pretty good bet.
Yeah, I think I noticed I met with an older gentleman when I was just starting out in my career, and he had this maybe 20% allocation to what he called good old American business, and there was these things that he owned, like the GEs of the world and the IBMs of the world. And I said, why do you own this stuff? You're never going to get any growth there. And he said, yeah, but I've got other sections of my balance sheet for growth, right? Like this is a company that bolts aircraft engines onto planes all day long, and they make money doing it, and they're always going to do it. And there's something to be said for that. Is that having a stake in the ground? It's a stability factor, and you're not trying to go huge with that. You're trying to own real, credible business. And you're right. The doomsaying kind of talk is very popular, and it goes on and on and on. And eventually, one day, it's right. But you can go broke if you try to trade that.
EB, the past 10 years have been particularly difficult for mining investors. You had that '08 crash, which brought the mining shares down, albeit they were at a very lofty level at that point. And then they started to march back up with everything. In fact, they went up faster than the U.S. equities did, but you had this negative correlation start to take hold in 2011, and that went on for 5 years, and you could argue that it was the worst bear market in mining stocks in the last 100 years by a few metrics. It seems like things have turned in the past year, but I want to get your sense on where we are right now, because some weakness has once again emerged in the mining market.
So for me, and by the way, we can talk about this later, but I was managing a fund during part of this downturn that you're talking about, so I can speak with a lot of experience to the difficulty of kind of shepherding people through this. But the way you describe it is right. You look at the chart now, and what you see is in 2008, we had this downturn, we had a quick rally, then we had a sustained 5-year downturn. This is all about inflation versus deflation. And the big call that most people got dead wrong was missing deflation in 2011. And you really had a 5-year period, almost 6-year period, where you had extreme deflationary forces, where the right trades were long the U.S. dollar. I mean, who would have thought that, right? Based on the behavior of the government. Long the Treasury bond. I mean, it's very difficult to convince people to buy Treasury bonds in 2011, and long stocks like healthcare. Meanwhile, healthcare was being basically destroyed by Barack Obama. So you had all these things that, in retrospect, you can see them on the chart, but they didn't make sense. Well, what can we learn from this? Well, what we can see is that you had this powerful deflationary trade, and that was the winning trade. But what I believe is that trade is over. And in 2016, January, February, you had the first tipping point back into an inflation trade. Look at a stock chart on U.S. Steel, which is a company plagued with problems. It's unbelievable how U.S. Steel ran, ticker symbol's X, and how it ran after the final low in January of 2016. And everyone rode that into the summer of 16, and then they said, well, what are we doing now? Well, I'll tell you what we're doing. If you study bull markets, which I do, there are these difficult and trying tests that go on at the beginning of a new trend. And the same thing happened in the other side of it. When we flipped to a deflationary trend, there were tests where the inflationists looked right to start with. Oh, this is going to come right back. But it didn't. We were really in a deflationary trend. And so now I think we're in an inflationary trend, and it might take a matter of months to really see confirmation of that, but you can see it very swiftly. If you look at a chart of the dollar over the last 3 or 4 weeks, you see a lot of weakness, you see a double top, you see a lot of things to be concerned about. Meanwhile, the mainstream is still very optimistic about the dollar. But I think right now, if you wanted to play a little bet with your neighbor or your coworker, bet on the euro. I mean, nobody's willing to bet on the euro right now, but the dollar index is made up mostly of euro. And so it's really dollar versus euro. And I think what you're going to see is the dollar be a lot weaker than people realize. I think the administration also wants a weak dollar.
Do you think we could get this really amazing opportunity for mining investors? Because if you look at it right now, it's the total opposite of '08. Back then, you had U.S. equities and gold stocks way up together. But now you've got U.S. equities way up and gold stocks way down. Do you think this negative correlation could continue? Gold stocks go up, while real estate, U.S. equities, the dollar all go down. And wouldn't that be an awesome buying opportunity for people that are right now have their capital deployed in mining?
I think so, because what people do is they overlook the sector because of the historical issues. They'll cite something that went on 10 years ago or something. They'll say, well, Bre-X in the 90s, you can't trust that. I mean, there's always some reason that they have to overlook the sector. But that's the time when you want to be really interested. And so right now, you've got this nice shot higher last year for the first half of the year. It's very, very meaningful from a charting perspective. If you look back at it, it's very serious. It's not just a little blip on the screen. It's a serious change of trend. And now you have softness after that. So this is the point where you can go in and you can say, well, what do I really want to own while nobody's looking at it? I mean, there's almost no New York analytical coverage in the mining sector. It's very interesting, and having run a fund in the space, I can tell you have to go to Canada to get that coverage. And so nobody in New York is looking at this stuff. I mean, whereas they've got 1,000 analysts looking at healthcare, for example. which is a total mess. And so you can look through the mining sector and you can say, what is it that I want to own? And what you want to own is one of two things. You either want to own an asset that's going to be coveted in the future because it has the ability to stave off certain problems that can plague other assets. For example, it has proper people. It's in a nice jurisdiction that tends to be mining friendly, has competent leadership, and it has a sensible share structure. It's not totally out of control. You can always see what management's done through the downturn. It's a dead giveaway of what's going to happen going forward. So you either want to own that or you want to own something that's going to create value, that's going to actually make something more valuable right in front of your very eyes. And so those are the two places you want to pick. Well, with that in mind, right now you can look through 1,000 small mining stocks and you can get down to a list of a dozen that you say, not only would I want to own these, I'm totally happy owning these if it takes 6 or 7 more months for this inflation trade to kick in. No problem with that at all.
Yeah, EB, I don't want to try to slip this in slyly. We were discussing a company prior to the call. You're actually partners with Doug Casey in that you're both invested here, and you're a director. We discussed this with Doug when he came on the program just a couple months ago. And here at Palisade, we oftentimes partner with Doug in that we find ourselves in the same deal, and we're always happy when that happens. The company's Metalla Royalty and Streaming, and I just want to get a basic overview from you on what you like so much about the company.
So there's a backstory here, and the backstory is really centers around the president of that company, Brett Heath. And I've known Brett for a long time, upwards of close to a decade now. And Brett was my partner in a capital management group where we bought and sold gold equities, and we're very involved in the sector. And so Brett and I know each other really well, and we work together in this capacity. And so when we closed that fund, I went to work, in the newsletter business, and Brett started his own streaming firm. And so I was kind of with him each step of the way there. And last year he decided to take that public, and Doug and I were initial investors. And I introduced Doug to Brett, and we spent a lot of time together. And we wanted to make a bet on Brett Heath, and that's what we've done. And it's very important kind of to know that, because, it's not the type of situation where, somebody just says, hey, would you be a director of this company? Oh, yeah, sure. Why not? Nothing else going on. It's a very strategic bet, because streaming is a business that's all about creating value. And it's really a finance business. It's much less about hunting for gold somewhere. A streaming company can have as few as 2 or 3 employees. And so if you're going to have 2 or 3 employees, it's all about the employees. Those are the guys that are going to determine what happens with the stock. And so we can talk more about streaming, but really that, it's a big bet on leadership. That's really the bet that we made when it comes down to it.
Yeah, I believe bar none that streaming is the best business in mining. As you pointed out, it's a finance business within the mining sector. You've got low burn and exponential returns with leverage to the commodity. I personally have stayed out of streaming, but the reason for that was that I felt like a lot of the gains were already gone. You've got these big companies like the Royal Golds and Silver Wheatons, and we're trying to make big returns. And when these companies are already at 10 billion market cap, they might be great for a portfolio looking for steady returns, but they're certainly not going to give you that massive leverage. And that's why I want to talk about the leverage that you can get out of these smaller streams.
Yes. And by the way, think about Silver Wheaton. The original company was actually called Chap Mercantile back in 2004, and they changed the name of the company. And I think the initial stock was a quarter or 40 cents or something like that, with a half a warrant or something. There's great history online about this, but when you look back and you just say, well, wow, that would have been worth getting involved in, so it's fun to kind of look at how these things fly before people really notice. And, all the guys at Silver Wheaton are great people. I mean, they've built this kind of steady business. And, but like you say, the problem is they're huge. I mean, Silver Wheaton just can't go out and put $10 million to work. I mean, they literally can't cover their own overhead doing that. Now, don't get me wrong, they don't have an overhead problem. It's just that you get to be a certain size with a certain amount of capital into the billions, and you've got to do really large deals. And there's just not that many big deals around the world. You look at kind of Pascualama and these different deals that are kind of the huge known deals out there. And of course, there's companies like Nova Gold and different groups that are working on larger projects. And perhaps there's an opportunity for these bigger streaming firms to get involved there. But there's just not that many of them. I mean, you and I could name them all count them on one hand. So in the smaller side of the gold business, what you have to understand is that last decade, the mining sector kind of woke up. And what happened was people just poured capital into it. And when that capital came in, everybody went out with their pickaxe and went looking for gold. And some people found it. And so now, 7 or 8 years later, you've got these guys that say, well, I found 2 million ounces in Mexico. I mean, that's pretty good, right? Yeah, it's pretty safe. There's plenty of gold and silver production. Well, what do we do now? And these projects need to come online because you don't have massive mega projects. They've kind of all been found. I mean, I'm sure there's one lurking out there below the surface somewhere in the world. Maybe someone we know will find it, hopefully. But there's just not a big pipeline of those deals. And so you've got a few big streaming companies fighting over those deals. You have very few companies that are looking at a 2 million ounce producer with 100 million CapEx and saying, yeah, we'll do a deal with you. I mean, of course. I mean, this is a deal that works, and you can do it at $1,250 gold. As you say, you can have great leverage to gold at today's prices, and if each time the gold price goes up, it directly impacts the return the streaming company makes. And I think it's important to kind of make sure people understand that. Is that, let's say you do a deal today and gold's $1,250. Well, if gold goes to $1,350, you're making $100 extra per ounce, and your costs do not change. So for the mining company, that's not the case, because your workers will go on strike. The local government wants more money. Fuel costs are higher. Caterpillar wants more money for the bulldozers. All kinds of problems. And that's if everything goes right underground in the mine. As a streaming company, you don't care if any of that stuff goes wrong, because all you care about is you agreed to buy 2 or 3% of the mine's production forever and pay $400 or $500 an ounce for that gold in exchange for the investment that you made. And so you have just incredible leverage to the upside, if gold does do something. But it's better to get into these deals assuming gold will do nothing. That's a much more conservative way to enter the deals, and that's Brett's philosophy, and we agree with him, because you're not betting on the future. You're saying, well, I'm going to make a bet based on what I know today, and if the future works out better for me, I'm going to be very, very excited.
In our business, EB, we've worked on trying to get some of our larger positions financed in a stream setting, and sometimes those companies are only looking for $2 or $4 or $5 million. The same amount of work that goes into the due diligence for a big mine, or at least the same knowledge base to put a stream together, is required for a small one, and it's really hard to find people out there, groups sophisticated enough to put a stream together, even though they are lucrative. And that kind of is what I find so interesting about Metalla, having Brett involved and just so much opportunity out there.
Yeah, so and that's the key, is that you can really pull in some of these resources from the outside. If you see, Metalla has an announcement that it's under letter of intent on a streaming deal right now that should close at some point in the reasonable future. And this is all news that's out. And if you read very closely, you see you can dispatch as many consulting geologists as necessary to the project, right? I mean, these guys are more than happy, to collect a fee to go fly halfway around the world, take, a boat, 2 helicopters, and a mule, and get to the project and do as much work as you want. So, I mean, it's, as far as putting the deals together, what's amazing is almost all of the pieces that you need to bolt together a well thought out transaction are things that you can use a la carte. There's law firms in Toronto and London that this is what they do. They do resource lending, and they're used to working for some of the larger firms, and they're more than happy to work on smaller deals. And so, once you get the hang of it and know all these people, which Brett's the mastermind behind this. I mean, it's not me, it's not Doug, certainly, it's the management team. But I've met these guys. I was just in Toronto recently. We had a dinner with a big legal team that's doing a bunch of work for us, and these guys are incredible. They're there when you need them. You turn the meter on, it starts running, and when you're done, you turn it off. it's much better than a staff of 50 people.
Well, EB, we're getting a little bit over time here. I want to make this maybe a recurring thing where we get you back on the program. Any of our listeners, you know who EB works with. He's partnered with Doug. And if you have any questions, just general questions or specific ones, feel free to throw it in the YouTube comment section, and I will ask EB directly on our next interview. EB, anything else to add for our listeners?
Well, I think that's it. I mean, I think we should get back together and see if the things we predict are right or wrong. It's always fun to do.
Absolutely. EB, thank you so much for coming on Palisade Radio.
Thanks for having me, Colin.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen, or are you too stupid?